You're listening to a Directors Talk interview with me, Giles Arber, and Robin Savage, the research analyst at Zeus Capital. Robin, good to talk to you again.
And to you.
Now, Robin, you've published today a 28-page note on OnTheMarket. Came out this morning. Can you tell us what the key points are?
Well, the note summarises OnTheMarket's achievements in its first 11 months as a listed company. So the first achievement is that it's increased its network of estate agency offices using it from 5,500 to over 12,000 offices. It's done it two ways. One is by recruiting key agent groups to sign long-term contracts, and secondly by offering first year free to around about 6,000 offices. And secondly, it's increased its brand value, measured by the Google ranking and the quality of leads given to agents. And this has been the product of increased marketing spend. And the third thing is that it started to convert the first year free agents. In December, it converted 60 offices to paying contracts, full tariff paying contracts. My forecasts for the next few years assume 2/3 of the free paying agents convert, and the sort of average typical tariff is something like £350 a month. And by the winter of 2019, I expect OnTheMarket will be profitable on a monthly basis.
Sounds good. Okay. Now, 31st of January is OnTheMarket's financial year end. What can we expect in the form of a trading update?
Well, I expect OnTheMarket's year-end pre-close update will confirm the number of offices. I expect it'll be close to our forecast of 12,500. There's a number of offices using the OnTheMarket portal. Secondly, the number of agents that have moved to full tariff from first year free. I expect that will be still a sort of double-digit number. I mentioned in December it was 60 had moved. The number of leads generated continuing to rise year on year. You'd expect that given the increased marketing spend, and the cash balance left at the year end after the recent marketing campaign. My forecast assumes around about 14 million. Investors should note that the majority of OnTheMarket's revenues are contracted on a multi-year basis, and with £14 million of cash and contracted revenue of over £14 million per annum, the portal is well funded for the next 12 months or so.
Brilliant. Now, just talking about investors, how can they judge the value of OnTheMarket shares?
Well, share prices reflect not just the expected investment returns, but also the market for a specific stock, the numbers of buyers and sellers. So let's first deal with the investment returns, and then we'll look at the market. We see three steps to OnTheMarket shares trading on traditional price-earnings ratio, which reflects future investment returns. The first thing is it's got to build its network of estate agent offices to over 12,000, which is what it's already done. The second step is converting first-year free agents to full tariff. So it really needs to get over 10,000 paying offices in order to break even. And the third is building that revenue and revenue stream so that there is a attractive profit stream coming out, and that will be through the provision of additional services and increasing subscription rates by under 5% per annum. The whole point about OnTheMarket is that over half the shares are owned by estate agents, that it will be thinking of the estate agents as being a sort of genuine partner in the whole process, and that the pricing is going to be at a sustainable and appropriate level. So which certainly compares to its competitor Rightmove. And while OnTheMarket is building its revenue stream, I think it's sensible to value the shares on either a price to revenue or a price to office basis, as this is effectively looking through to the period when it should be making profits. I expect on the market's revenue for the year to 31st of January 19 to be of the order of £14.5 million. In the first half of the year, let me remind you, it generated £7 million, so 7.5 with the additional paying agents that were contractors in the first half and some contributing in the second half. And that the annual revenue that would come from converting agents with maybe 5,000 first-year free offices could be annualised at something like £21 million. Our forecast revenue for the period to January 2020 is £28 million, reflecting the conversion of about two-thirds of last year's first-year free agents. And by 2020, 2021, it ought to be able to deliver a respectable EBIT margin of, say, 30% on a revenue base of, let's say, £67 million. And that would result in a valuation which could well be £300 million or about £3 a share, which is 4.5 times revenue and £18,000 per office. Now, compare the £18,000 per office to what it is at the moment. And at the moment, at 80 pence a share, it's trading on about £4,000 per office, which is clearly low compared with Rightmove, which at its IPO was valued at £60,000 an office and is now valued at £230,000 per office. So I expect the on the market to make a series of announcements this year as its revenue stream grows. In terms of the buyers and sellers, Exhibit 22 of our research notes shows the volume of buying and selling at different prices, and you can see clearly that from market information that the volume weighted price last year was 143 pence compared to 80p now, and there's very little amount of stock being traded below £1.10, suggesting that buyers in any significant volume would need to pay over £1.10 to get stock. So what I would suggest is that if there were any serious institutional interest on the market, you could see a very sharp movement because there may not be enough stock around.
Interesting. Okay. Talking to us today was Robin Savage, Research Analyst at Zeus Capital. Robin, thanks for joining Directors Talk today.
Thank you. Thank you very much. Bye.